Okay, so one of the big things that's talked about in one of these recent chapters is something called transaction exposure. And this is the type of currency risk that you encounter when you have accounts receivable, you've got accounts payable, you've got debt interest, you've got payments, money flows one way or the other in a foreign currency. Because you don't know what the value of that currency is going to be by the time you receive it. For example, you book a sale today, but the agreement typically is that you don't actually get paid till some point in the future. Since you don't know what the value of that currency is going to be in the future, that currency that you're getting paid in, that's transaction risk. There's risk in this transaction. There's currency risk. So there are three different ways which we can eliminate foreign currency risk, where we can eliminate our transaction exposure. There's the options market hedge. We can use options to hedge our exposure. There's the money market hedge. We can do a slightly convoluted strategy by using money market investment accounts or borrowing money in the money market. And then there are forwards, the forward market hedge, or its equivalent if we're trading on an exchange, a futures market hedge. Futures and forwards basically the same, other than trading on an exchange or not. The one key difference between those two and options markets being that options provide this asymmetric payoff where we can, the hedge kicks in if the currency moves against us, but otherwise it doesn't, and we get to enjoy the upside. So it's asymmetric. Okay, so let's compare a few of these different options to hedge a sale that we as a company incurred, and the sale generated an accounts receivable in a foreign currency. So as with all hedges, one thing we could do is basically nothing, and then we could just instead wait to collect on this foreign currency and just accept whatever risk comes with that. And if that were the case, if we didn't actually hedge, then our proceeds from this £5 million accounts receivable as a US company would be whatever that currency was valued at the end of 90 days. So if this is the spot rate today, let's take a look. The spot rate today is US dollars per British pound, 1.7720 USD per British pound. And then just assuming that doesn't change, then over the next 90 days, what we'd have when this foreign company finally pays us in British pounds, and remember, 1 British pound buying more USD means that if we're going from British pounds to USD, we should have a larger number. We should end up with a larger number here. And that number that we get is 8,860,000. So assuming no exchange rate changes, this is what we would collect. But let's say instead that we expected we had some forecast of what the USD per pound was going to be 90 days from now. And we forecasted that it was going to be 1.805 USD per pound. And we can do the same thing, remaining unhedged, assuming that the spot rate moves as expected, this 1.805, then what we would end up with when we finally get paid from our supplier in British pounds and we go convert that 90 days later just at the spot market, this being that expected spot rate at the end of 90 days, we end up with $9 million and 25,000. So you can see there's some benefit if we have an expectation of where we think the currency is going to go, and we were really convinced about that. In this case, that the British pound was going to strengthen, buying more USD. Then in this case, not hedging and just kind of benefiting from those tailwinds gives us almost an extra $200,000 in US dollar denominated revenue. But of course, we're taking a risk. We're just sort of betting that the British pound is going to strengthen and we're going to collect more in terms of USD. And companies that aren't trading companies often don't want to bet. They don't want to take that risk. They're just not in that line of business. And so let's see how they could avoid that risk and sort of lock in what they're going to get, exactly what they're going to get, which may help them plan and just move on to other things that are core to their business by using a hedge. So let's say that we try a forward contract to hedge first. So let's say that we went to a bank and got a 90-day forward rate quote, and dollars per British pound, it was offered to us at 1.7470 USD per British pound. So what we're doing with this is if we agree to use this forward contract, we're agreeing to take the 5 million pounds that we receive in 90 days and sell it through this forward contract at a pre-specified rate of 1.7470 dollars per pound. And so we're really just agreeing up front about what rate to transact in 90 days. And so mathematically, there's not much difference going on here in terms of how to calculate the proceeds from a forward hedge. Here in this scenario, we end up with $8.7 million. So yeah, forward contracts is my personal favorite because it's so quick and easy to do. But let's take a look at the proceeds we'd get if we were to use a money market hedge instead. So let's add this to our results with hedging booklet and then check out a money market hedge. Okay, so with a money market hedge of an accounts receivable, you have a couple different moving parts. You know that you're going to receive this accounts receivable, and it's going to be in some foreign currency. And you know you're going to receive it in the future. What you do in a money market hedge of an accounts receivable is that it's sort of like you immediately today go to a bank, and it's going to be, in this case, a bank in London, or just a bank that offers $0, so a foreign currency, and you borrow the foreign currency amount. So you know you're going to receive pounds, and so you borrow pounds today, immediately, as soon as you book this sale. And then again, immediately, you take the proceeds from that sale and convert to your home currency. So in this case, we're going to convert to dollars. And you can see here, we're sort of done, because if we did this quickly enough, as soon as we booked the sale, we went to a bank and borrowed the proceeds in pounds. And with those proceeds, we converted it at the spot rate into USD. And so when I say we're done, I mean we're done with foreign currency risk, because we now know, because we have it, how many USD we're going to get. And so the only thing we need to do to kind of tie off the rest of this piece of the rest of this puzzle here, the only other piece of this puzzle we need is that we take is how do we kind of close this loan? And so the idea here is we borrow from the bank. This is 90 days. We're going to borrow for 90 days. And that's because this accounts receivable is also 90 days. And at the end of the 90 days, when the company pays us for the product we sold it, when it makes good on its accounts receivable, we take the proceeds from those, which are denominated in British pounds, and go and pay off our loan in London that was also denominated in pounds. And it all kind of is a closed loop. We borrowed just enough pounds to be covered by this accounts receivable that we were expecting. And when we borrowed that, we had immediately converted it into dollars at the spot market, and then we got our proceeds, and then we went and did stuff with it. So the only other things that we need to think about is, with this hedge, we immediately went off and did stuff with the money. So as a company, it's always nice to have money today rather than later. And we got that with this hedge. Instead of having it 90 days, we got the currency today. But we paid a bank some sort of interest rate to have that benefit. And so we also kind of have to factor that in. So let's say that interest rate from this London bank is 12% per year. And that our weighted average cost of capital is 10% per year. And this weighted average cost of capital thing here, that's here because we get this money today when we borrow from the bank, and then we get to go and do stuff with it for 90 days, something productive. And so whenever we make an investment, whenever we invest in anything as a company, we have to consider the weighted average capital, because we want to, it's sort of like, if we had this money today, what could we do with it? What return could we achieve with it? Or, if we went with this project today, we should at least earn, say, 10%, because, if we went with this other project or a number of other projects, we can earn 10% there. So the weighted average cost of capital is to account for this time value of money aspect of getting the money today, in contrast to some other hedges, like, say, the 90-day forward contract hedge, where we had to wait 90 days to convert the currency and actually get the US dollars. So our WACC is 10%. And I think at this point, these are all the things that we need to do a money market hedge. So our proceeds from a money market hedge, what we're going to do is borrow the accounts receivable amount in British pounds at a London bank, or any bank that will let us borrow in British pounds. But we're not going to borrow the full amount, because we have to pay interest on that loan. And so when it comes to 90 days later and we want to pay off this loan, we need to ensure that these accounts receivable, the £5 million that we receive, is going to be sufficient to pay off not only the loan, but the interest due on it as well. That's why we deflate this accounts receivable, or decrease it, by the borrowing rate at this London bank. And since this is a 12% per year interest rate that we're borrowing, and we are only borrowing for 90 days, we scale down that 12% by 1/4. So this is sort of our step one here in the money market hedge strategy. And our step two is to convert that amount at whatever the spot rate is right now, the spot rate today. And our spot rate today at the time of booking this sale is 1.7720 USD per British pounds. So what we're doing is taking those proceeds and then converting it at the spot rate. And then our step 3 is what I like to call do stuff. We're going to take our proceeds and go and invest and do things that a company does with the money. And our expectation, given that our cost of capital is 10%, our WACC is 10%, is that we can, whatever we do with this money, we can earn at least a 10% return with it. That 10% return is on an annualized basis. So de-annualizing that to 90 days gives us all we need for our final step. Now, you might wonder why we need this final step. And the real reason for it is that we want to compare. Eventually, we have the option of doing these different hedges. So far we've looked at just a money market hedge and a forward rate hedge. And what we really care about is the net proceeds. All of these different approaches eliminate our exchange rate risk, but they're going to give us different proceeds. And so to really make one hedging strategy comparable with another, we need to put them on the same footing. And what I mean by putting them on the same footing in this case is that if we receive this in 90 days, if this is a forward rate hedge, we receive that money in 90 days, we want to know what the equivalent amount is going to be. Since it's an extra benefit that we're getting this money up front with the money market hedge, we want to put it on sort of equal footing with this other hedge that's occurring 90 days later, where we actually collect the money 90 days later. And that's why we put this tail end thing here with a weighted average cost of capital for 90 days. All right, so let's calculate this out. From here, we can just take the numbers given and plug them into this formula. Step 1, our 5 million pounds. We're going to borrow that, but a little bit less to account for the cost of interest. That way we can ensure that our accounts receivable 5 million is enough to pay the interest as well as the loan. The spot rate today, when we convert the proceeds of that loan today into dollars, is 1.77. And then when we go and we immediately get those proceeds, we go and do stuff with it and earn an investment return of an annualized rate of at least 10%. And so our proceeds using the money market hedge end up at $8.8 million. And we can now add that result to our hedging tab of various hedging options. And that leaves us with one additional approach to look at, and that's going to be our options market hedge. And if you recall, using options have this interesting feature where it provides a hedge for us, but it also leaves a little bit of upside for us. As a result, we kind of pay a premium to get into that. So here we're expecting to get 5 million pounds, but we don't know what that's going to be in terms of dollars. It could be more or it could be less than what we were expecting. If the pound strengthens, then we end up with a lot of US dollars. But if the pound weakens, then we end up with quite a few less dollars than what we were expecting. What an options approach allows you to do is it allows you to actually benefit if the British pound strengthens, which is something that these two approaches didn't provide for you. Here we locked in the forward rate that we were going to trade at, and here we immediately converted at the spot rate, so it's one and done. There's no upside in contrast to what is here with an options hedge. What an options hedge does, though, is it still hedges, because if the British pound weakens, that's when the option kicks in, and you can eliminate the financial detriment that can occur in that scenario. Specifically, if we buy a put on the British pound, that will pay off if the British pound weakens. If the value of the spot rate goes down, So if this is denominated in terms of US dollars per British pound, then if, this number goes down, 1 British pound is buying fewer dollars. If the eventual spot rate falls in value, that means the British pound is weakening. And that's not good for us because we're going to be receiving those British pounds, those 5 million, and that's going to translate to fewer dollars for us. But that's good for a put option. So that's when this put option on the pound will actually make money. When we most need it, this thing is going to pay off and profit from a falling British pound. We're going to take that profit then and then use it to offset the weakened amount of dollars that we get when we finally collect on this accounts receivable. But given the options formula, if it goes the other way, if the pound strengthens, we get the maximum with this options contract of either this amount or zero. And so if the pound really strengthens, we can sort of just X out this component and just have an option that's, not worth anything to us. But that's fine because if the pound strengthened, that means the value of these accounts receivables in terms of dollars is going to go up substantially. And so we're still in a good situation. So with an options hedge, you get to keep the benefit, you get to keep the upside, but you also get to eliminate the downside. That's that asymmetric payoff that's happening here. That's unique to an options hedge approach. But the one sort of this sounds great. Why not always go with this approach? The one thing that's also unique to the options hedge is the cost. So up front, you have to pay this premium, this fixed amount that win or lose, you're sort of out of pocket on regardless. So let's check out the proceeds that we can generate from an options hedge with some specific numbers. So one thing we'll need with an option is its strike price. We'll have to select the strike price that we want to utilize. And here the strike is 1.74 USD per British pound. This comes at a cost. We're going to select a put because a put is what will benefit if the pound weakens and we're getting paid in pounds. So we want to make sure what we get paid in when it translates to dollars is worth as much as we can get. The put premium on this option is 1.5% total. So this is going to be 1.5% of the total option size that we buy. And what we're going to buy is a full protection on our accounts receivable. We're going to buy a $5 million put. So in dollar terms, that put premium is going to be 5 million pounds times 1.5%. And note that this number here is going to be in pounds. 5 million pounds times 1.5% is still, 1.5% of 5 million pounds. So we also need to take the spot rate today, since we're buying this option today, we're still paying for it today, of 1.7720. That will give us the total cost of this option in dollar terms as it's paid today, the premium of the option in dollar terms. So one final thing to remember, though, is that we're comparing each of these approaches, the money market hedge, the option hedge, and the forward rate hedge. And while you pay for this option today, like the forward rate hedge, you don't receive the benefits until some point in the future, at the end of 90 days. It's paid for up front, but the proceeds are not received until the accounts receivable actually gets paid, 90 days. And that's why we have to account for the cost, the lack of benefit in having to wait to pay for this thing right up front, but have to wait to receive its benefits by using the weighted average cost of capital again. And that weighted average cost of capital was 10%. So this gives us a total cost in dollar terms for the premium of this option, how much we pay and we don't get back, of $136,000. So if that's the cost, then let's check out the benefit. And the truth is, we don't really know the benefit of the option. We don't know its full benefit until 90 days is finally over, because the benefit really depends on what the spot rate ultimately ends up at. Because we get to keep the upside from an options market hedge, all we really know is that we've capped our downside. But if the pound really strengthens and that ends up translating into a lot of USD, how much that translates into, we just don't know until the end of 90 days. All we really know is that we've kind of capped our downside risk. We're not going to get less than a certain exchange rate. And as it happens, that certain exchange rate that we've capped our downside risk on is determined by the strike price of the put option that we bought. So if the value of the British pound weakens, that's when this put kicks in. And, we're still at if this is sort of our profit on the put option, we are in negative territory here just because we paid the premium. And if the pound ends up stronger, let's say $1.9 per pound, then, this option's worthless basically, and we've just lost our premium. But anything beyond this 1.74 strike, we start to generate profit on this put. And the further the pound falls, the more profit that this thing makes. And it's here where we've begun to cap our loss at 1.74 minus the premium paid. And as far as the formula for that, like reflecting that in terms of the proceeds that we get, if the British pound falls in value, specifically below the strike, to calculate the proceeds, all we really need to do is multiply that 5 million accounts receivable, which is also the size of this put option that we bought, multiply that by the strike price. Because anything below that, the put option, the gains on that offset any losses from a reduced value of the accounts receivable. So the two kind of net each other out, and in the background, it's a little, complicated to think about how that's happening. But mathematically, the proceeds from this option position, we just take the 5 million pounds, multiply by the strike price of that option, and then subtract out the cost of paying for this option, which, even though this option turns out profitable for any value of the pound below 1.74, we still have to pay that premium. So for anything in 90 days, if the pound falls below 1.74, anything at any value below 1.74, our proceeds are still guaranteed because of this option to be worth $8.56 million. That's our proceeds if the British pound falls. We've locked in a gain or a certain amount of proceeds here. And so we're almost done, and we can add this, to our running tally of proceeds from these various hedging options at this point. But we're almost done because while we've calculated the proceeds to this option hedging strategy approach, if the pound weakens, we haven't actually yet calculated the potential proceeds if the pound strengthens instead. And because an option has this asymmetric payoff profile, that's something that we need to consider. We won't be able to exactly quantify it since it really depends on what the spot rate ends up at 90 days. But we can get some idea of how this would affect our potential proceeds. And I'm going to draw that with an example in this region over here and just keep everything we've done over on the left side. But essentially what's going to happen is that this 5 million pounds received for us in 90 days, we just wait and see what the spot rate's going to be. And if it's below the strike, then we end up with this route. But if the pound actually strengthens, and let's say it strengthens quite a bit in 90 days to 1.90 USD per British pound, so the pound's buying many more USD than it did just 90 days prior, then those 5 million pounds in terms of USD translate into quite a bigger number. Here, in the case of a pound strengthening, we end up being paid. We still get paid the 5 million pounds, but in dollar terms, that's $9.5 million. And the only thing we need to account for, that's great news, we just have to subtract out the fact that we paid for this option premium, and whether it kicks in or whether it's worthless, we still have to, we're still losing that premium. So you can see that the option proceeds really depend. It's really uncertain until the final, when we finally get paid for these accounts receivable. We've capped our downside. We still know the minimum amount of proceeds that we're going to get, but the maximum amount of proceeds that we get really depends on what the spot rate ends up at the end of 90 days. So if we're adding this back to our final tab of potential proceeds, if the British pound rises to some value above the strike, then we're just going to get whatever that value is, that increased value in dollar terms, and we'll just be out that option premium. But that amount is unknown until we finally get paid. All right. So with that caveat about options, we can now compare our proceeds from different hedging options, hedging strategies. And in this case, the one with the highest, surest proceeds is going to be the money market hedge. We're going to receive $8.8 million in compared to going with the forward hedge. So I think if I had to choose between these two, I think it's pretty clear that we would choose the money market hedge, because both, they assuredly give me the same amount of money, but it's the money market hedge that ultimately gives me the same amount, or the greater amount. But the tricky part is to whether, should we select from the money market hedge or from the put option hedge? Because this is the minimum amount with the option hedge. I know I'm going to get at least this much, but I really don't know what the maximum amount is going to be. And it could be even bigger than this 8.8 million that we see here. And ultimately, it just depends on whether I think that British pound is really going to strengthen over the next 90 days beyond the point of $8.8 million. It's really that decides whether I want to do a money market hedge or an option hedge. But these are, somewhat subjective questions that you would face in reality. But for the purposes of, problem solving for this course, these are the kind of things you need to get to, is just to be able to use these formulas and calculate the total proceeds.